Welcome back. Now, Life Healthcare has reported a strong operating performance at the halfway stage of the financial year. The private hospital operator reported robust activity growth and benefited from acquisitions concluded in the second half of 2024. CEO Peter Wharton-Hood joins us now for a detailed analysis of that performance. Thank you so much for your time, Peter. Now, just paint a picture of the fuel behind, firstly, your top line growth and really how much room you had in terms of increasing your pricing and expanding your margins.
Well, it was a tough operating period, and we produced a solid result under the circumstances. As you can see from the reported numbers, we grew revenue by a shade over 8%, and that was fueled by the increase in paid patient days through our facilities, which basically means we got more people through our hospital complexes during the 6 months. And that led to a slightly higher revenue increase than the tariff increase, which was low single digits, which was given to us for the period.
When you talk about a positive case mix, what does that look like?
Well, in effect, as you have more surgical cases, you have surgical and medical cases in a hospital complex. So the case mix is the ratio between medical and surgical cases. And as you would understand, surgical cases require the use of theatres. And if you have more theatre cases, i.e. more surgical cases, you have a positive case mix. If you have more medical cases, then you have a negative case mix. And we had an increment in our surgical case mix ratio.
All right. Peter, it was mentioned that progress on the renal acquisition integration has been slower than expected. What's affecting that pace, and is there a target timeline for full integration?
When you buy a new business, it clearly doesn't operate with the same policies, protocols, and procedures as your existing business. So when we talk about integrating the business, it's about making the new business look like our existing business, if I can use that as a comparison.
Yeah.
It's taken us a bit longer than expected because the timeline to conclude the transaction between when we reached the original agreement with the seller and us actually being able to get our hands on the asset and operate it was delayed by some of the regulatory filings that needed to take place. And in so doing, the time frame taken to solve some of these integration issues has taken longer than expected. We would expect to complete the bulk of that integration by the end of this calendar year, and that's certainly the objective that the management team is working towards.
All right. And since we are on this topic of acquisitions, how much room is there for acquisitions, and what will inform your decisions there?
Well, we have a fortress balance sheet, so we have lots of capacity to take up opportunities as and when they may present themselves to us. You have seen from our announcement that we've made pretty bold statements around investing in a new hospital in South Africa. And that takes time, it takes money, and it takes attention. We're also expanding our existing hospital complexes where the number of ICU beds and high care beds is short relative to the demand. And that also takes time, energy, effort and money. So at this particular juncture, the executives are not scouring the world for another acquisition. We actually have got our hands on the steering wheel and we're running our Southern African operations. But that doesn't mean that people don't phone us, and that doesn't mean that we won't take the phone call and evaluate opportunities as and when they arise. So open-minded, but at the moment, the focus is on the South African and the Southern African business.
Well, Peter, let's go into kind of your strategic direction, particularly looking at the assets that you have and the assets that you've let go of. A lot of people saw AMG and LMI as the crown jewels in the portfolio. Where are you seeing then the most upside for growth outside of those businesses?
Well, having disposed of those two particular entities, bearing in mind that Life Molecular Imaging, we've still got one regulatory aspect to complete, we've become Southern African focused.
Okay.
And the reasons for the disposal of the international businesses were not because they weren't profitable. It was because the cash requirements in AMG were draining the South African resources. And in the context of selling Life Molecular, it wasn't that it wasn't an exciting business. We just realized that it required a different shareholder and a different owner to take it to the next level. So whilst we've sold LMI, subject to the regulatory filings. Just to remind shareholders that we've still kept the upside to some extent in the milestone payments that come our way as that business continues to prosper. So that means that we took the right moment in time to dispose of those assets at good prices with good value for shareholders. And the focus is on the Southern African operations.
I mean, that's a very interesting point that you make there, that the focus now is on the Southern African operations. We know, of course, the risks that are embedded in the operating environment in the region. Is Life Healthcare comfortable in navigating those risks?
Absolutely. We can't stop treating patients or building capacity to treat sick patients just because there's regulatory uncertainty. That would be irresponsible, and our jobs are to be able to navigate through uncertainty. So in the context of where we see the current uncertainty playing out, we understand our responsibilities in owning and operating hospital complexes. We're hopeful that the disagreements, or shall we say the uncertainty, goes away, because where there's regulatory uncertainty, capital tends to be a bit skittish.
Yeah.
And the last thing this country wants is for foreign investors not to want to invest in South Africa or in the healthcare sector. And regrettably, over the last 2 or 3 years, foreign investors have shied away from the sector because of the uncertainty created by this high-level dialogue that has not been constructive.
All right, I hear you on that, Peter, and a really insightful point that you make there. And just as we wrap up the conversation, what should we be looking out for in the second half of the financial year?
Well, I think just to build on the point around uncertainty, Life Healthcare is committed and publicly stated that public-private partnership, collaboration and cooperation is the way to improve the accessibility and affordability of healthcare in South Africa. And during the second half of the year, we will continue to say the same things, looking for those aspects where we can cooperate with government. The second half of the year, we'll continue the build-out of the domestic footprint, as we outlined in our presentation today, and the optimization of those underperforming assets in the portfolio are now under the microscope. How do we actually get some of the complexes that are not running at full capacity or near to optimum capacity up to speed? So there's detail, it's operational detail, and it's a positive story where we see growth coming in the second half of the year along the same lines that we had in the first half.
All right. Well, thank you so much for your time and for your insights and really detailing the level of growth that Life Healthcare saw in this reporting period. That was Peter Wharton-Hood, CEO of Life Healthcare.